Ladies and gentlemen, good day and welcome to the ECOS India Mobility and Hospitality Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Hashika Mutreja from Adfactors PR. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone. A warm welcome to you all, and thank you for joining us today for ECOS Mobility and Hospitality Limited's Quarter 4 and Financial Year 26 Earnings Conference Call. We truly appreciate your time and continued interest in the company. We are pleased to have with us the senior management team led by our Chairman and Managing Director, Mr. Rajesh Lumba, who will share his perspective on the company's performance for the quarter and financial year 2026. He is joined by our Chief Financial Officer, Mr. Hem Upadhyay, who will take us through the financial highlights. Before we begin, I would like to remind everyone that certain statements made during this call may be forward-looking in nature. These statements are based on current expectations and are subjected to risk and uncertainty that could cause actual results to differ materially. With that, I now hand over the call to Mr. Rajesh Lumba for his opening remarks. Thank you, and over to you, sir.
Thank you, Ashita. Good afternoon and a very warm welcome to all of you. Thank you for joining us today for ECOS India Mobility and Hospitality Limited's Q4 and the full year FY26 earnings conference call. I would like to extend a sincere welcome to all our long-standing investors and analysts, and a special welcome to those joining us for the first time. As many of you are aware, ECO is India's leading organized corporate managed mobility solutions provider. We operate in two core segments. One is employee transportation services, which we call ETS, and shopper-driven car rentals for CCR. Our clients include major Fortune 500 companies, BSE 500 companies, global capability centers, ITS companies, consulting companies, manufacturing, pharma, and a fast-growing list of Indian enterprises and SMEs. We currently operate across 130 plus cities in India and have a presence in more than 30 countries globally where we provide our services. The common thread across all this is a focus on delivering organized, compliant, and technology-enabled mobility solutions. In a market where a significant portion of corporate ground transportation continues to remain fragmented and unorganized, we believe this remains an important differentiator for ECOS. Our strategic partnership with Sixt SE. Now, Sixt is one of the world's top 4 or 5 car rental companies. This strengthens ECO's positioning as a global mobility solutions player beyond India. Through this exclusive India GSA arrangement, ECO customers now get access to Sixt's premium self-drive car rental network across 100 plus countries. This partnership enhances our international mobility offering while creating new cross-sell and enterprise-level travel opportunities for ECO. So this Sixt is used both by business travelers and leisure travelers. Our strategic focus has always been to drive sustainable growth by onboarding high-quality new clients, deepening the wallet share with existing customers, and expanding our presence across new geographies. During FY26, we accelerated our efforts across all 3 areas simultaneously, while continuing to strengthen our execution capability. Starting with our operational performance now. For the full year FY26, we completed approximately 5.23 million trips compared to 4.04 million in FY25, which is a growth of approximately 29% year on year. Both our ETS and CCR segments have contributed to this growth, and the demand environment from the large corporate clients continues to remain very healthy for us. In EPS, we have seen stable demand from IT and ITES companies and a very good demand surge from our GCC clients. While in CCR, there has been a good demand growth across our highly diversified client base. On client additions, we onboarded 223 new clients in FY26, out of which 64 were added in last Q4 alone. This compares with the 188 new clients added in FY25. Today, our active client base now stands at over 1750. What I want to highlight is not just the number of new clients, but the quality of these relationships as well. Many of the accounts added during FY26 are large enterprise relationships where onboarding involves a structured and often lengthy evaluation process. So these wins reflect the strength of our service standards, compliance framework, and our execution capabilities. The strength of our existing relationship continues to be the cornerstone of this business. 55% of our FY26 revenues comes from clients who have been associated with ECOS for more than 5 years. This level of client retention reflects the consistency of our service delivery and the trust we have built with customers over time, one trip at a time. Coming to our fleet capacity. During FY26, we serviced customer requirements through our vendor partner network of over 20,000 vehicles across India, compared to around 14,000 vehicles in FY25. This represents a broader supply ecosystem available to ECO to service demand across all our client segments. The increase was driven by geographic expansion and onboarding of additional supply partners to support the new customer acquisition and strengthen the service reliability across 130 plus cities. This continues to remain and keep us asset-light, and on an asset-light model, with a large portion of the fleet sourced through our vendor partners. On the technology front, more than 14% of our CCR bookings from corporate clients are now powered through either our Cab Drive Pro platform or our API connections or our customer app during Q4 FY26. We also launched our direct web booking portal during Q4 FY26, enabling customers to seamlessly pre-schedule safe and reliable rides in advance. Now, this initiative is not aimed at entering the mass B2C space, but at better serving customers and users who specifically prefer the eco experience and service standards. We believe this is an important step in extending our enterprise-grade services and platform to individual premium users and SMEs, broaden our reach beyond the traditional long-term contract channel. We have launched also a new core backend platform which will help us optimize process efficiency while further enhancing the customer experience. So technology for us continues to be a key differentiator in this business, particularly in the CCR segment, and we remain focused on strengthening our digital capability. So as we enter FY27, our focus is on translating the scale we have built over the last few quarters into stronger growth, a sharper execution, and improved operating discipline. Over this period, we have continued to strengthen our operating capacity and execution capabilities across markets in line with business growth, and we are seeing encouraging traction across client additions, trip volumes, and the large enterprise clients engagements. At the same time, we remain disciplined in balancing the growth with profitability. As accounts mature and utilization improves, we expect operating efficiencies to improve progressively over time. More importantly, the broader industry opportunity continues to remain strong, particularly as large enterprises increasingly consolidate mobility spending with organized and technology-led partners. We believe that ECOS remains well positioned to benefit from this structural shift. With that, I hand it over to our CFO, Hem Upadhyay. Over to you, Hem.
Thank you, Rajesh sir, and good afternoon, everyone. Let me now take you through our financial performance for Q4 and full year ended March 31st, 2026, and provide some important context around the key movements. Beginning with Q4 FY26, revenue from operation for the quarter was 2067.60 million, showing a year-on-year increase of 16.65% over Q4 FY25. The quarter witnesses continued traction across our core business segment, supported by deeper engagement with existing enterprise clients, onboarding new accounts, and sustained demand across key markets. EBITDA for quarter came in at INR 241.53 million as compared to 264.67 million in Q4 FY25. Profitability during the quarter was impacted by continuing investment towards business expansion, technology, strengthening organization capability for future growth. Coming to the full year performance, revenue from operations for FY26 stood at 8081.58 million, reflecting a growth of 23.58% over FY25. During the year, we continue to expand our enterprise footprint, establish our national worldwide network, and enhance execution capability, all while maintaining our asset-light operating model. EBITDA for FY26 stood at 939.29 million. Margin during the year was influenced by higher manpower cost, expanding leadership bandwidth, investment in tech, and competitive pricing environment, especially in the ETS segment. In addition, during the year, we made a one-time provision for doubtful debt of approximately 80 million as a part of our prudent approach. The company remains focused on execution discipline and improving operating efficiency going forward. From a balance sheet perspective, we continue to remain a strong financial position with healthy cash flow, low leverages, and disciplined capital allocation. As on 31st March 2026, our cash and investment stood at 1373 million, providing us with significant flexibility to support future growth initiatives while maintaining financial prudence. Overall, FY26 has been an important year in terms of the strengthening the scale, depth, and resilience of the platform. And we believe that business is well positioned to capitalize on long-term structural opportunity in organized corporate mobility space. Thank you. I will now open the floor for questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Janam Shah with Equirus Securities. Please go ahead.
Thanks for the opportunity. Hope I am audible clearly.
Yes, Janam.
So first question is related to the West Asia crisis. So two things to it, how it is impacting our demand. What we see is that in 9 months, the growth rate has been more than 20% across the quarters. This quarter also, we had a good growth rate on a YOY basis, but on a sequential basis, fourth quarter has always been the strongest quarter, but revenue was flat versus 3Q. So is it because of the West Asia crisis impacting, let's say, our CCR segment, or how do we see this particular thing? Along with that, let's say, if any growth guidance that you wanted to give for FY27.
Yes, of course, the Middle East crisis did affect our CCR business, where the growth was not well as expected in March. Till February, it was going great guns. But post the this Middle East crisis, in March we saw a little bit of dip in the growth. So to that extent, we and I think maybe a lot of other players in the travel trade have been affected. But we saw a good bounce back going ahead. So eventually we see if this does not continue for too long, we don't see much of an impact coming in.
Got it, sir. And what would be
And for the second, what our growth, considering all this, what we would look at is around an 18 to 20% growth in the coming years is what we can aspire to.
Got it, sir. And what has been the contribution between both the segments for this particular quarter and for the full year?
For the full year, for full year it is 58% to ETS and 42% to PCR. And in this quarter, it is 57% to ETS and 43% to CCR.
Got it, sir. So another question is also on the West Asia crisis. Because of that, eventually the fuel price, both petrol and diesel, has now increased by around, let's say, 6-7%. And even the other CNG price has also increased. And what we see is that going forward, let's say, how we will be able to pass on this increases to our clients, because our contracts would be, let's say, getting renewed on a timely yearly basis. Do we have any built-in escalation to pass on everything? How our, let's say, the supplier community has passed on these hikes to us, and how do we see this impact on our margins overall?
So, as far as the fuel escalation is there, it varies from contractual obligations from client to client. But in most of our contracts, it is a pass-through. Once the price increases over a certain threshold, typically anywhere between 5%, we pass on the entire hike to the client.
Okay, and so largely our margin is not much impacted because of maybe time lag would have been there. Otherwise, things would be largely stable.
Yeah.
Okay.
There may be some time lag. Some cases it may be a few days, and some cases maybe a few weeks.
Okay, got it, sir. So, any broader margin guidance you wanted to give for this time, along with the revenue guidance of 18 to 20%? Any broader range?
So, if you look at EBITDA, I think with a disciplined approach and maintaining operational efficiency, we should be this year able to deliver anywhere between 11 to 13% in terms of EBITDA.
Got it, sir. And sir, what's your view on the competition? Like, given the price hikes or the fuel prices also increased similar to us, everyone will be passing it on, or they'll be holding on price to, let's say, get some market share from us or maybe any other person?
We are seeing different, especially in ETS, we're seeing a competitive price environment, where it depends on strategies from company to company, where how much of pricing one wants to give to acquire a client, etc. So we have seen some competitive pressure over here, but we feel there is a certain threshold which more or less is there in the market, beyond which it doesn't make sense for people who are not willing to burn money as such to go below. So we are well within that range.
Got it. So just last one question from my side. What we have seen during this year is that in FY26, two of the costs. One is other expense because of the provisioning that we have created, and another one the employee expense because the investments that we have done in our employees to have the better growth going forward. This too has impacted margin a lot. How do we see this run rate going forward? With the 18 to 20% growth, will this expense will be eventually down to, let's say, provide some operating leverage to us? And what's our view on the receivable that we have provided for around, let's say, 8 crore rupees in this year? Are we seeing any movement over there? Are we getting it in FY27 or anything like that?
As regards the manpower cost is concerned, definitely we are going to see, we saw a good increase last year, given, that we had given good hikes to everybody. This year, what we are seeing is we'll be seeing a much more muted growth in our manpower cost, which should give us some operating leverages over there, while we are looking at also expanding our leadership bandwidth in senior positions this year. Your other question was regarding other costs, increase in other costs, right?
Yeah. So the 8 crore provision that we have provided, overall other costs would have not been that high as a percentage of revenue. So that will also provide some operating leverage for us in the next year.
Yes, of course. So that was a one-time, and we have already, that is under legal proceedings for recovery of that money, and we are very hopeful of the recovery. As regards your, so what was the last question again?
Yeah, this was on the recovery only. So what's the status over there?
Yeah. So legal proceedings are on, and we are very, very hopeful of recovery.
Got it, sir. Yeah.
It may happen this financial year, or maybe it's going into next financial year. That's the maximum.
Okay, sir. Thank you so much. This is from my side.
Thank you.
The next question comes from the line of Dikshit Doshi with Whitestone Financial Advisors. Please go ahead.
Yeah, thanks for the opportunity. So some of my questions have been answered. So just a couple of things. Firstly, you mentioned that now 14% of our CCR business comes through our app. So still a large portion is coming through the email. So what stops client from switching from email to app, and how in terms of cost and everything it helps us better when it comes through app?
Coming through email is more about client behavior, which changes only over time. Typically in the corporate B2B space, people have become more used to and comfortable just sending one line email to book their car, or it comes through their centralized administrations or travel booking offices. So wherein they end up also using the email, while we are constantly at it and offering various user interfaces and incentives for our clients to shift over. Cost impact is there. More than cost impact, we are trying to convince our customers about the speed of our response, which is much faster if they will use our app and our online booking platforms. So we have almost a 50-member central contact center team, which of course does all the tracking and 24/7, and also answering customer queries in addition to entering the reservations which come over email. So we see that also as a factor of creating stickiness and pampering our clients as per what they need. At the same time, pushing them to adopt technology more and more.
Okay. And in terms of client addition, you mentioned 223 clients, and now we are at 1750. Can you give some idea about how much client would have stopped using our service this financial year?
See, we have a long tail of clients if we look at all of the 1750. But our major clients, if I were to say our top 200 clients, the churn is minimum. Maybe 2 or 3% is what's over there. While clients who may be using you 2-3 times in a month, they keep coming and going, and depending on their needs, which may not be constant and consistent.
Okay. And last question, any thoughts on dividend this time? I think there was no dividend was announced.
So dividend was not on the agenda on the board meeting we had yesterday. We're going to be setting up a separate board meeting to discuss about dividend or other alternate ways that we can increase the shareholder value. So that's on our mind, but no decision as yet.
Okay. That's it from my side. Thank you.
Thank you. The next question comes from the line of Jigar Jani with Nuvama PCG Research. Please go ahead.
Yeah, hi sir. Thank you for taking my question and congratulations on a steady set of numbers. Sir, a little bit theoretical at this point, but have you seen any impact on the ETS business from the PM's appeal to kind of go for work from home as much as possible to save fuel cost? Have you seen any demand impact on the ETS business on that front?
Not as yet, Jigar. We were also a little worried about when we, saw that, but there has been no impact as of yet. Really.
Understood. Yeah. So you are not seeing any demand go down or companies kind of adopting it voluntarily?
We constantly in touch with our customers, and most of them already have well matured work from home policies already in place with a certain segment of the people working from home, and those who need to be in office and they just need to be in office. And that they have determined over the last 3-4 years post-COVID, when this return to office aspect started, and there has been a lot of debate and discussions on this matter already, and people are pretty well settled into the final outcome of that debate and discussion as to who all needs to be in office and who can work from home.
Understood, sir. And just in relation to the previous participant's question on benefits from operating leverage, just trying to quantify, so we have been around 22 crores of quarterly run rate in employee expenses, about 8-9 crores in other expenses. How much increase do you see in these numbers for the build out of the senior management team and any employee addition that you guys are planning to do? What kind of number or increase can you see?
Voice is breaking. Can you just repeat, Jigar?
Yeah, just a moment. I'll just switch. Just in one. Hello, is this better?
Yes, better.
Yeah. So what I was trying to understand is on your employee and other expenses part, we are about at 22 crores employee expenses and other expenses are about 9 crores. Considering the senior management build out, what kind of increase can we expect? Would it be lesser than the revenue growth that we are expecting? If you could quantify the number, what kind of plans you're looking at on both employee and other expenses?
So in terms of our HR cost, we would expect approximately anywhere between 13 to 15-16% growth in the employee cost. That is what we are budgeting for in the latest AOP.
Okay. And other expenses also similar range?
Other expenses would see around 8-9% increase. Not more than that.
Okay. And so this growth that you are guiding for 18 to 20%, tentatively, how much of this will be organic growth from existing clients and how much would be new client addition that would contribute? Just trying to understand where the growth is likely to come from.
So our both of them are engine drivers of growth. The organic growth by increasing the wallet share of our customers, wherein we know there is still every year there is a headroom to grow with more and more vendor consolidation happening. At the same time, we have a very large and well established sales team who is also running for the growth. So I would say most of the growth, around 60 to 65% of the growth should come from new client acquisitions and the rest from the organic.
Understood. And so lastly, on this margin guidance of 11 to 13%, does that assume that fuel cost won't go higher or you have accounted for the pass on and the impact of the fuel cost and that will be partially offset by the operating leverage that you guys will get? Is that accounted for as of now?
Most of the fuel cost is a pass-through only. There may be some impact because of certain lag period which may be there in certain accounts, but most of it is a pass-through. So we are not too worried on that account.
Okay. So that your guidance accounts basically for those variations that might come in.
Sorry?
Your guidance of 11 to 13% accounts for these variations that are likely to come in on some of the contracts that might.
Yes.
Okay. And then lastly, so just to summarize, what I would assume is that if since the last 3-4 years, we have grown very nicely on the top line, but due to one or other factors, our margins have been impacted. From here on, would it be fair to assume that your top line growth will reflect largely into your bottom line growth going ahead if everything remains the same and there are no exceptional circumstances in the environment?
Of course, the objective and effort always is to have, a sustainable growth. And there are periods when there is a spurt in the top line growth by new client acquisitions, etc. And it takes a little while for us to get the focus back for those clients into the bottom line growth and the margin expansion with regard to those specific clients, especially if they happen to be large clients. So it's kind of cyclical in that manner, wherein a large spurt of growth in terms of top line is also accompanied by a little bit margin shrinkage, but then it makes up with more concentration on margin expansion in the future quarters.
Understood. So from here on,
the lifetime value of our customer is very high. The average is more than 6 months or 6 years that a customer stays with us. So we have good amount of time to expand margins with that client.
Understood, sir. Thank you so much for patiently answering my question, and best of luck for the future. Thank you so much.
Thank you.
The next question comes from the line of Pulkit Singhal with Dalmus Capital Management. Please go ahead.
Thank you for the opportunity. My first question is on, our view around the usage of EVs in the fleet. I think, again, because of the West Asia crisis and, obviously, the air pollution thing, which has been going on for a while, many corporates would also probably want to internally move towards fleet vendors who have a lot more EVs in their fleet. How do you think about investing in that area as a way of creating a competitive advantage going ahead for the next 3 to 5 years?
Yes. So while we don't have any dearth of capital to invest, but we are still cautious in our approach to allocating capital towards EVs, in spite of there is a surging demand, but we are still approaching cautiously because we feel there are now a very, very few products. Earlier there were none. Now we feel there are very few products which are mature enough to handle the rigor of our kind of business in the EV segment. Plus, our decisions are also based on our assessment of the charging infrastructure which is available for these vehicles, and also things like the residual value of the vehicles, etc. So we still approach this cautiously and are ramping up in a sustainable manner the number of EVs that we have and that we offer to our clients. So there are still a lot of challenges and still a lot of myths about the efficacy of EVs that continue. So we have to be cautious in that account.
Right. So this is more to do with a lot of the technology change. So 3 years out, there are a lot of new launches that will happen. But your stance could change 3 years out on this?
Our stance could change 3 months down if we feel that everything is. Two things. One, the product in terms of the vehicle has to be something which is not in workshop 25% of the time. Number one.
Yeah.
Number two, if I'm running IC vehicles, I am not putting up my petrol pumps and CNG stations, correct? Why should I have to put up charging stations, right? If I have to run EVs. Yeah. So these two questions need to be answered. Very, very simple. A lot of things in life are pretty simple as long as you don't carry it away by media hype.
Yeah. In terms of your capex, you've done almost 120 crores of capex last 4 years, averaging 30 crores a year. How do you see the next 3 years?
So unless we see, the first question about EV investments, if we see those conditions developing where EVs are are very much norm and they are sustainable financially, we will see a larger investment in EV capex over there. Otherwise, we expect the same trend to continue.
Okay. Lastly, on the margin bit, I mean, given the new realities of the market, the amount of investments you're doing for growth, etc., I mean, how would you think of the band 3 to 5 years out? You used to operate at 14 to 16% in the past, but is it fair to say 11 to 13% reflects the newer reality, or how would you think about things?
EPS, we feel yes, the price competitiveness will stay for a while. But in CCR, which is more of a brand play, and our focus on building our brand, we feel we will be able to, somewhere offset that with the growth of our CCR business also.
Okay, great. Thank you.
Thanks.
The next question comes from the line of Nilesh Doshi with Prospero Tree AMC. Please go ahead.
Thanks for the opportunity, sir. Most of the participants have asked about the increase in the cost, operating cost and future outlook, because our revenue growth is around 23 to 24%, but the two major operating costs, employee costs and other expenses increased by 42%, in which the other expense include the one-time 8 crore write-off in the quarter 2, which you mentioned that it is likely to be recovered. That's okay. But sir, what is the future outlook for the revenue growth, and will this cost remain as it is or will increase in the same proportion to the revenue growth, because our revenue growth is 23%, operating costs increase by 40%. There must be some component of the fixed cost which is not increasing in the same manner, but here our operating costs increase more than the revenue cost. So kindly explain the future outlook for these two costs and revenue growth.
Yeah. So, sir, it was a valid question, and I think I answered part of it in the other question also just a while back. So we do not expect a similar growth in cost this year. It will be much more reasonable is the expectation in terms of our cost growth, and we hope to kick in some operating leverages starting this year.
Because, sir, at the time of the IPO, our operating margin was around 15%. Now it fell to 18.5%. If there is a revenue growth, but it does not convert into the operating profit, then how our bottom line will be improved? It is the revenue growth is more important for the startup. Now we are the established and mature player. Is it only the revenue growth is important, or the profit growth for the shareholder is also important, sir?
I think both of them go hand in hand. We are looking at it as a mature business for the long term. The revenue growth and demand generations remains the lifeblood and lifeline of the organization of the business. At the same time, we have to be focusing on our margin expansions, on our building our brands also, and that is how the margin growth also keeps happening.
If possible, kindly explain what is our focus area? It is the revenue growth, or we will control the cost also?
It has to be both. I mean, there cannot be one focus area. I cannot sacrifice revenue growth for expanding the margin in any 1 year, because then I'm compromising my business for the future. Okay? So we have to focus on both, and we have to see how we are able to draw balance between the growing the revenue and also expanding the margins.
Okay, sir. So let's look in the first quarter that there will be some improvement in the operating margin. Okay, thank you. All the best, sir.
Thanks, sir.
Participants, in the interest of time and fairness to others, please restrict yourselves to 2 questions. For any more questions, you may rejoin the queue. The next question comes from the line of Hiten Boricha with Sequent Investments. Please go ahead.
Yeah. Thank you for the opportunity, sir. So my question is again on the revenue. So when we say we have seen a very good growth in a number of trips, which is I think 30%, 29, 30% odd growth. But when we see our revenue per trip, so it is consistently coming down. So last year it was around 1,600, and this year it is 1,550. In FY24, it was somewhere around 750, 780 odd per trip, revenue per trip I'm talking about. Can you throw some light on that? What is happening on that side, sir? Are we not increasing our realization or the pricing to what about the pricing side? If you can explain on that, sir.
So there has been some competitive pricing pressure. So because of which we have seen some dip in the average ticket size. But this average ticket size, in some ways, it can be little misleading also, not just because of pricing. Yes, there is a pricing pressure, and because of pricing also, the ticket size come down. But it also may have come down because of shorter trips in ETS or more airport transfers in CCR. So it's a combination of factors. But yes, there is a competitive pricing pressure. Little bit, it has been more in ETS than in CCR. But yes, you are correct. There is a little bit of competitive pricing.
Okay. So what kind of growth then we are expecting in terms of number of trips, sir? And sir, related to this question only, you also mentioned that we are passing the cost of fuel cost. So are we passing that immediately, or is that a lag of quarter also?
No, the lag can vary between a few days to a few weeks, not more than that.
Mm-hmm.
So typically, the contracts are like, okay, if it goes over X percentage, then we pass on the entire cost. Till that percentage, we have to absorb. So, for example, now it's happened more than 6-7% increase happened. So it's been all been passed on to the client.
Okay. And a continuing question on the pricing pressure. So are we seeing this pressure to like kind of slow down, or is it going to go up only because
we have seen a slowdown in terms of we have seen the water kind of found its level in the last quarter also, and we have at the same time we have also been winning more and more contracts at large enterprise contracts at a scale we have not won before. So it is both going hand in hand.
Okay. Thank you.
Thank you.
The next question comes from the line of Saurabh Dole with Friars Assets. Please go ahead.
Yeah. Good evening, sir. Good afternoon, sir. So basically, I have two main points to pick your brains on. First is when you look at the scale advantages that come from, let's say, some of your older accounts, because I think around 55% of the business today is accounted for by accounts which are greater than 5 years old. So I want to understand how has the margin trajectory on those accounts been, and what is the delta between margins on those accounts versus the margin on the consolidated entity level numbers. So that is question one. And the second one is when you penetrate deep into a client, is it purely you taking market share from somebody else, some other vendor that the company may have, or is it also because you may discover, or the company or your client may discover newer use cases once they start working with you? So those are my two questions.
So I'll answer your second question first. So our new client acquisitions are a mix of both. Older clients who are, looking to consolidate their vendors or looking for better quality vendors. And secondly, there's a huge growth in the number of new GCCs and manufacturing facilities that are opening up in India. And a lot of growth in terms of the enterprise clients is also coming from there for ETS. As far as CCR is concerned, our growth is mostly diversified. The new clients, new companies, old companies, and across all sectors. It's a highly diversified growth that we're seeing in CCR. Can you just repeat the first question? I'm sorry.
Yeah, the first question is, when you look at some of your old accounts, I think 50% of the business is from older accounts. So what is the margin trajectory of those accounts?
Yeah. So, margins is not only a factor of pricing, it's also a factor of how we're able to run any operation, especially the complex ETS and the large CCR operations, how we're able to run them most efficiently and derive our margins by cost optimization. So it's always a mix. It's not that and older clients will give you lesser or higher margin than newer clients. It's always a mixed bag.
So do you then mean to say that, if the business goes, whatever, 4-5x from here, we are still unsure about what the margin trajectory will be?
No, what we are looking at it. I don't know what's going to happen 5 years down the line, but definitely for this coming year, what we are looking at is reasonable to expect a margin of between 11 to 13%. In fact, not just for the next year, but even for the next couple of years, and where we are making our efforts to optimize the operations in such a manner and reduce our overhead costs to get the operating leverage kicked in.
Got it. Thank you so much.
The next question comes from the line of Arnav Nawalkha with Trisula Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So I just wanted to better understand ECOS's value proposition. So, sir, if you could shed some color on what are the core capabilities that gives us the right to win against local fleet operators and unorganized players. Also, if you could shed some color on if you're taking any initiatives on continuous basis to stay ahead of the curve and probably strengthen our proposition against our peers.
So, if you look at ECO, it is talking about our value proposition and our right to win. It's the ability to deliver a consistent and predictable quality of service across geographies, especially for the larger and more complex transport requirements. And they could be ranging from, the large enterprises which have large transportation requirements. It could be conferences, events, things like that. Then the right to win then comes from our ability at one side, our deep relationships and our credibility and our reputation in the market on the client side, which gives them the confidence to depend and trust ECO for all the complex transportation requirements. And other side, the supply ecosystem which has been built over decades, which is not easy to replicate, to ensure that in an asset-light model, you can keep delivering that same consistent and predictable level of service to your customers every trip at a time.
Understood. Yeah. And then across both our CCR ETS verticals, so are ECOS's services typically priced at a premium, discount, or largely in line with the other operators?
I'm sorry, can you just repeat? Okay.
Yes. Okay. Across both our CCR and ETS, so are ECOS's services typically priced at a premium or discount or largely in line with unorganized operators?
If I were to look at CCR, we command a certain premium. In terms of ETS, depends on the complexity of the operation. If it is a very complex operation, ECOS does command a premium, or it is a preferred vendor for a lot of our clients. And strategically, if we feel that we need to, be in line with the unorganized also, we are able to, match them. At the same time, we are able to run that operation more efficiently because of the high density of the demand that we have, allowing us to have multiple sources of supply for the same client.
Thank you. The next question comes from the line of Sahil Sharma from Dalmus Capital Management. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just wanted to understand a bit more on this competition that you have been discussing. So are we seeing this competitive intensity from the more, traditional players or the existing players, or from some of the new age, companies tech companies that are coming into the space?
So, that's a very good question, actually. And we see this more of the price competition that comes in from the new entrants who would want to put the foot in the door and are looking at price as a weapon to do that. At the same time, so on one side we do welcome more and more organized players coming in, and because we feel that this further accelerates the ecosystem to move from unorganized to organized players. And it's a fairly old time practice that you reduce your prices and you try and get in. And final proof of pudding is always how you can sustainably run that operation over a period of time. And we feel that this has a certain life cycle, and wherein thereafter the prices do rise because you cannot keep unsustainably having an unsustainable business model that solely relies on pricing. And customers also realize that. We've already seen that happen.
Thank you. Ladies and gentlemen, due to time constraints, we would take that as the last question for today. I would now like to hand the conference over to Mr. Rajesh Lumba for their closing remarks. So please go ahead.
Oh, sorry, that's me. So thank you for this opportunity to interact with our investors, and we look forward to this new year or the new financial year. Our team is completely energized, and we look forward to creating more and more value for our shareholders in the coming year.
Thank you. Ladies and gentlemen, on behalf of Adfactors PR and ECOS India Mobility and Hospitality, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.